welcome back to Book Club, Part 2, Chapter 6. And Part 2 is about understanding building indicators from the ground up. Glad you returned. All right, let's jump into it. Okay, in this part, start your understanding of indicators by examining their building blocks, bars, a ton of information. It really says bars. That wasn't like a Gen Z thing. A ton of information resides in each bar and each small collection of bars. You can actually trade on bars alone. Don't skip this step. Review a special set of small patterns containing only a few bars. These small patterns are reliable predictors of upcoming price action. Make the alternative to standard bars, the candlestick notation version of bars, part of your toolkit. Candlesticks were immediately adopted wholesale within a few years of being introduced in the West from Japan, and for very good reason, that they add to your visual recognition of trendedness. All right, Chapter 6, reading basic bars, how to pounce on opportunities. The standard bar seems so basic and ordinary. It depicts the open, high, low, and close, but bars contain more information than you might think. Reading price bars is the perfect application of the saying, actions speak louder than words. Traders may say that the price is going up, but the price bar tells you what they really think by showing you what they actually do. This chapter gives you the basics on how to read standard bars. The standard bar I talk about in this chapter isn't the only bar notation method out there. There are also the tick bar, momentum bar, point and figure bar, and most importantly, candlestick bars. I describe each of these later in the book. The candlestick bar, which came on the scene only 30 years ago, has zoomed to the top of the popularity rankings and is likely used by at least half of the technical analysts working today. That's because it's visually compelling, whereas the standard bar appears boring in contrast, until you tease out all of its meanings. A variation on candlestick bars is the Heiken Ashi bar. Ooh, I hope I'm saying that right. But if you're interested in knowing more about it, you can check out the Investopedia entry. Okay, so building basic bars. The price bar is the basic building block of technical analysis. After you have a grip on the price bar, almost nothing in technical analysis can confuse you for long. Honest. Resist the temptation to skim over the bar material to get more glamorous sounding stuff. The bar is the building block of most indicators, which are nothing more than an arithmetic manipulation of the four price bar components of a series of bars over some period of time. Get the classic bar concept down pat, and you can make a giant leap into technical analysis. For example, one of the most popular indicators is named the stochastic oscillator. See Chapter 13. It uses a formula that includes the high, low, and the close. You should have a firm grip on the high, the low, and close if you're going to appreciate this indicator. In addition to being able to grasp indicator construction, you want to figure out how the bar works, because every change and a trend begins with a bar or small series of bars. Some traders never bother to move on to indicators at all and trade solely on classic bars. In fact, I made more profit in my own trading while I was writing this chapter than any other time in my trading life. I start off here with a brief overview of the price bar and then detail each component in the sections that follow. Reality in a nutshell. The price bar describes and defines the trading action in a security for a given period, meaning actual deals done with cold hard cash, not what someone wished, imagined, or contemplated. For the sake of simplicity, this chapter refers to the daily price bar because that's what you'll be working with most of the time. A price bar can be in any increment, a minute, 10 minutes, 240 minutes, or a week. It doesn't matter. All price bars contain an open, high, low, and close. The price dynamics I describe here are valid for all bars of any time frame. Check out the standard price bar in Figure 6-1. Like all bars, it consists of four components. The open, the little horizontal line on the left, is the open price. High, the top of the vertical line defines the high of the day. Low, the bottom of the vertical line defines the low of the day. And the close, the little horizontal line on the right, is the closing price. This open high low closed component set of the price bar is often abbreviated OHLC. The two little horizontal lines on the price bar are called tick marks. In trading parlance, a tick represents a single trade at a single price. So the tick mark representing the open or the close refers literally to a single transaction or a batch of transactions, all at the same price and at the same time. The high and the low don't need a tick mark because the end of the bar conveys that information. The daily price bar shows the effects of every price factor in the market for that day, including the overall environment, the fundamentals, and market sentiment. The price bar tells you the outcome of the battle between the buyers or bulls and the sellers or bears. Every bar identifies the winning group and losing group. If the price opened at a low and closed at a high, the winners that day were the buyers. If the price opened at the high and closed at the low, the winners that day were the sellers. Each bar reflects a very real contest whose outcome is measured in dollars. If the bar is very tall, encompassing a $10 range, when the normal bar for the security is only $3, the trading was a titanic battle. If the bar is very short, say $1, it was a pillow fight. On every single trade, one party wins and the other party loses. That is why trading, like war, is called a zero-sum game. The relationship between price and volume is important in judging the bar. Everything that you infer from prices about the state of mind of the market needs to be confirmed by volume. For example, if the price bar is 3 times the usual size, you should verify from volume that a large number of traders were active that day. It's a mistake to see a battle if only one trade was done at the $10 high. That makes the $10 price an anomaly. Setting the tone, the open price. The opening price is the first trade done between a buyer and a seller on the trading day. It reflects the new day's hopes and fears. The meaning of the open, like all the price bar components, comes from its relationship to the other components of the bar as they develop and to the components of the bars that came before, especially yesterday's close. The opening price may reflect factors other than sentiment about the security. Some decisions are arbitrary and random. Maybe Aunt Henrietta got up this morning and decided to sell Blue Widget shares at the open to raise money to buy a racehorse. Also, fund managers may buy or sell at the open to rebalance their portfolios to reflect new money in or out the day before. In the U.S. equities, the open often isn't actually the first trade of the day, but a synthetic price like an average of the first 5 trades, devised by the exchange or the data collector. This is why the opening price varies from one source to another. Not having accurate data drives some technical analysts nuts because the opening price sets the tone, and if somebody made it up, it doesn't matter how reasonable the calculation process, it's not literally the first price of the day. This problem is now compounded by the existence of several exchanges trading the same securities and related options. Some equity analysts say that they ignore the open because it's not accurate. And although in futures trading, the open is the real McCoy, in many instances, such as equity index futures and foreign exchange, trading has been going on in the overnight markets, so every time zone has opens. In other words, the actual open on a U.S. exchange may not be the written in stone benchmark you may think it is. So, should you heed the open? Yes. In equities, any particular opening price may not be accurate, but over a series of days, the open adequately represents the sentiment and at the beginning of the day and serves as a benchmark for evaluating the upcoming price action over the course of the day. And the placement of the open relative to the close the day before and the close today are 2 of the criteria for judging whether a security is trending. The opening price's most important relationship is the close of the day before, when the open is up. If the open is higher than the previous close, you deduce that the first trader of the day spotted fresh news, is expecting favorable news, or has some other reason to think his purchase will return a gain. If you too see a price rise coming, his action reinforces your analysis. The first trade sets the tone. When the open is down, if the opening price is below the close of the day before, look out. Maybe bad news came out after the close last night. The bad news may pertain to a political event, a change in interest rates, a bankruptcy in the same industry, or a dozen other factors. Okay, when we come back, we're going to go over summarizing sentiment, the closing price, when the close is up, when the close is down, going up, the high, hope, fear, and risk management at the close. All right. Thank you for joining. It's been a good, nice, short read, and I will see you tomorrow for the next read.